Hello, and thank you for joining Mayor Brown's webinar today, What the Basel Endgame Proposal Means for Delaware Banking Institutions. My name is Jeff Taft, and I'm a partner in Mayor Brown's Financial Services Regulatory Enforcement Group in the DC office, and I'm happy to introduce today's program. Joining me today are my colleagues, Matt Bisanz, a partner in our Financial Services Regulatory and Enforcement practice in DC, and Julie Gillespie, co-head of our Structured Finance practice and a partner in our Chicago office. Before we begin, let me cover a couple of administrative matters. If you are applying for CLE credit, we will provide an alphanumeric code during the presentation. Please record this code on the CLE affirmation form, which can be found in the connection details email we sent yesterday. The form will also be emailed to you within the next 2 days. For those who are applying for CLE credit, please note that the certificates of attendance will be distributed within 30 days of the program date. If you have any questions during the presentation, please let us know via the Q&A feature on the bottom of your screen. We will do our best to address these questions live or after today's program. We're trying to leave some time at the end for questions. We'll hopefully be able to answer some of them, but if we don't get to them all, we will follow up with folks. With that, let me begin. So, U.S. banking institutions obviously are subject to regulatory capital requirements, and I'm not going to spend a lot of time going through all of this, but basically those capital standards are based upon the Basel Committee standards. Those are international standards that are promulgated, and it's up to each of the countries to implement those Basel standards. Obviously, the U.S. does that through agency rulemaking, and that is, kind of where we are right now in the Basel process. Every country does it a little bit differently, and every country will potentially modify some of the Basel Committee standards themselves. And obviously in the US, we've done that in the past and we'll continue to do that based upon particular issues in those countries. Capital is based upon financial statements for accounting purposes. US regulatory capital requirements basically apply to all insured depository institutions, bank holding companies, most savings and loan holding companies, intermediate holding companies of foreign banking institutions, so-called IHCs of FBOs. They do not typically apply to the branches and agencies of foreign banks to the extent those are not insured depository institutions. U.S. banking organizations must satisfy capital requirements in a couple of ways. There's capital to risk weights. There's also capital to total asset ratios, the leverage ratios. Next slide. So what we're talking about now are, the Basel Endgame, basically provisions, and these were put out by the Basel Committee in 2017. They were designed, at least initially stated, to be some sort of fine-tuning on the Basel III requirements that came out right after the financial crisis. And people refer to it as the Basel Endgame, Basel IV, Basel III plus. Different names for it, obviously, but we're all talking about what's coming out right now, the Endgame proposal. What they do is they change risk weights under the standardized approach for credit risk. They restrict the use of advanced approaches models, which is something that the bigger banks had obviously been using. Restrictions on the credit value, the CVA risk framework. Overall operational risk, including more explicit operational risk in a standardized approach. We'll talk more about operational risk, but that's some of the changes there are pretty interesting. And refinements to the leverage ratio framework. So also there's an output floor on the regulatory capital benefits that derive relative to the standardized approach. This is kind of an enhanced standardized approach. The Basel Committee was supposed to, and these were supposed to be implemented last year at some point, but COVID obviously pushed a lot of the deadlines back. That deadline was extended to January of 2023. Obviously, the U.S. regulators are just getting out the proposal this year, so we're probably looking at another year before these are finalized, and then they'll probably be implemented soon after that, within probably 6 months. Next slide. Talk about the scope of the proposal, because I think it's important to understand who in fact is covered. Basically, U.S. banking organizations with more than $100 billion of assets or more typically what we think of as category 1, 2, 3, and 4 banking organizations. Just for your benefit, there's 8 USG SIBs, there's 17 mid-sized U.S. bank holding companies, basically the larger regional banks, some other niche organizations, some credit card companies and the like. There are also 8 intermediate holding companies of FBOs that would be covered. And then there are 3 to 4 other U.S. banking organizations that would also fall within it. U.S. banking organizations with significant trading activity, even to the extent they are not $100 billion or more, would also be covered. That's based upon having aggregate trading assets and liabilities exceeding 10% of total assets or $5 billion. This increases the current threshold from 1 billion to 5, and approximately 5 U.S. bank holding companies, several IHCs, and 4 to 5 other U.S. banking organizations would be captured by these changes. Again, these don't apply to FBOs or U.S. branches or agencies of the FBOs. They also do not apply to banking organizations subject to the community bank leverage ratio, so the smaller banks are basically the banks outside of the top 40 or 50 banks. Regulators obviously are tailoring the application of the capital requirements to federally supervised trust companies with certain exemptions. Next slide. And generally speaking, though, the rules don't change what is eligible for Tier 1, Tier 2 capital. And basically, those instruments remain the same. So if it's eligible Tier 1, Tier 2 instrument, there are going to be some additional disclosure requirements for holders of new Tier 1 and Tier 2 instruments for those institutions that are covered by the proposal. I think one of the big changes, though, that's coming in this proposal is that the accumulated other comprehensive income, AOCI items, will be included in the calculation of capital. In the 2013 rule, the Basel Committee basically scoped in AOCI, but in adopting that rule, the U.S. regulators effectively only required the advanced approaches banks to include AOCI and allowed other institutions to opt out. These changes are effectively going back and modifying that so that everybody who's effectively covered by the capital proposal would need to include AOCI. The fact is that inclusion will basically require banks, in order to maintain their current capital, to go out and raise capital requirements, because the AOCI number for some of them can be fairly significant. On average, AOCI constitutes about 18% of the common equity Tier 1 capital for the banking institutions. Having said that, would notice that it really varies amongst the institutions. You have a number of banks that probably are in the low range, 3 or 5%, and then you have some all the way up to 78%. So you can see that the inclusion of AOCI is going to have a significant impact on particular institutions, and that's something obviously that's going to have to be addressed by those institutions. Again, this is something that was required, not something that was included in the 2013 Basel requirements, but the U.S. really allowed many institutions to opt out of it, and now they're kind of revisiting that issue, and that's why AOCI is basically being included this time around, at least in the proposal. Next slide. Last thing I wanted to just quickly talk about are unrealized gains and losses at insured banks. This has been a big issue since what happened in the spring with SVB and some of the other turmoil around some of the other regional banks who had a lot of unrealized losses in their securities portfolio. As you can see on the blue dots here basically indicate what is basically picked up by the capital proposal. Obviously, held to maturity securities are not picked up by that. So while it's bad, it could be a lot worse, obviously, if the held to maturity securities were picked up. And I think over time, in order to address this concern, you may see more institutions obviously putting securities in the hold to maturity security bucket rather than the available for sale securities. Now, not everybody can do that, and that can't be done for every sort of security, but certainly I think people will become more intentional as to how they treat securities they're holding. With that, let me turn it over to Julie Gillespie, who's going to take us through some of the capital credit risk stuff.
Thank you, Jeff. Currently, all banking organizations calculate the amount of assets against which they must hold capital for credit risk under the standardized approach. The standardized approach requires banking organizations to multiply the amount of each on-balance sheet asset and the adjusted amount of each off-balance sheet exposure by a specified percentage called the risk weight to determine the amount of risk-weighted assets or exposures. Off-balance sheet exposures, such as unfunded commitments and letters of credit, are included by multiplying the exposure amount by a credit conversion factor prior to applying the risk weights for the type of asset. The proposal requires banking organizations with total consolidated assets of $100 billion or more to determine the risk-weighted assets under a new expanded standardized approach, as well as the existing standardized approach, and use the higher amount of risk-weighted assets when determining compliance with the regulatory capital requirements. This is referred to as a dual stack approach. In the next few slides, I will highlight some of the changes to the risk weights assigned to different types of assets and the credit conversion factors applicable to off-balance sheet exposures. The expanded standardized approach is intended to make the capital requirements more sensitive to the varying risk of different types of credit exposures and would create much more granular risk weights for real estate, as well as adding new risk weights for categories such as retail, subordinated debt instruments, specialized lending, commercial real estate, and acquisition, development, or construction exposures. The proposal also increases the conversion factor applied to off-balance sheet exposures, increasing risk weights for off-balance sheet exposures such as undrawn lines of credit. In addition, the proposal would apply more punitive treatment to exposures to commercial borrowers with any default versus increasing the risk weight solely for an asset that is actually defaulted. As we'll discuss in more detail, the capital proposal addresses securitizations by adopting a form of the securitization framework that is used in the advanced approaches currently, with certain modifications. Next slide, please. The risk rates for different types of assets are assigned in the capital rules and reflect a regulatory assessment of the comparative levels of risk of default for different types of assets. Under the current standardized approach, performing assets are generally risk-weighted at 100% and past due assets at 150%. As you can see from the chart, the expanded standardized approach assigns more granular risk weights to different categories of exposures. One new category is the transactor retail revolving category, which is assigned a risk weight of 55%. These exposures will include credit facilities where the balance has been repaid in full at each scheduled repayment date for the previous 12 months, or an overdraft facility where there has been no drawdown for the previous 12 months. So a credit card where the balance is paid off consistently each month would have a risk weight of 55% versus generally 85%. And retail exposures like auto loans and leases would have a risk weight of 85%. Next slide, please. As I referenced earlier, the risk weight for an off-balance sheet exposure is determined by first multiplying the exposure amount by a credit conversion factor, and then multiplying the adjusted exposure amount by the risk weight applicable to the underlying asset. The capital proposal generally would impose a more punitive treatment to undrawn credit commitments by raising the credit conversion factor for unconditionally cancelable commitments from 0% to 10%, and establishing a single conversion factor for all commitments that are not unconditionally cancelable. These changes may have a significant impact on consumer credit cards, as I'll highlight in a minute, and certain committed facilities supporting asset-backed commercial paper conduits. Next slide. The capital proposal creates many new risk weights for residential and commercial real estate, and their application is driven by dynamic loan to value ratios and reliance on cash flow from the property. These are similar to the more granular risk weights in the Endgame standard, but with a 20% increase to each risk weight. When calculating the loan to value, I refer to it as being a dynamic test, the loan amount will be reduced as the loan amortizes, whereas the value of the property generally will be maintained at the value measured at origination. Next slide, please. Under the existing standardized approach, residential real estate exposures are subject to only a few category of risk weights, depending on whether there are guarantees or statutory exceptions. Similar to commercial real estate, the NPR includes more granular risk weights for residential real estate based on LTV and reliance on cash flow from the property. Next slide. I wanted to highlight a couple provisions of the rule that are particularly relevant to credit card assets. The drawn portion of a credit card balance is currently risk weighted at 100%. As I mentioned earlier, the proposal adds a new category for retail transactor exposures that are risk weighted at 55%. Again, retail transactor exposures require a balance to be repaid in full at each scheduled repayment date for the prior 12 months. For credit card balances that are not transactor exposures, they will be risk weighted at 85%. There are certain categories of ineligible retail that are 110% and 100% for most corporate cards and 150% for past due cards. Retail will also include small and medium-sized businesses with less than 50 million in revenue or sales. As I highlighted earlier, with respect to the unused portion of a credit limit, the risk rate is currently 0%. The proposal would risk rate the undrawn portion at 10% of the equivalent drawn amount. So, by way of example, a 40,000 undrawn portion of a transactor card would be risk weighted by multiplying the 40,000 first by the 10% credit conversion factor, and then 55% for the corresponding risk weight for transactor retail, resulting in $2,200 of risk-weighted assets, or multiplying by 8% capital requirement, $176 of Tier 1 capital requirement. Commitments that do not have an express contractual maximum amount that can be drawn will be subject to a formula to impute a dollar amount. And the past year risk weight of 150% would arguably apply to the undrawn portion if a borrower defaults on another exposure or creditor. This is a very significant aspect of the capital rules because affected banking organizations have over $4 trillion in unconditionally cancelable lines outstanding. Next slide, please. The expanded standardized approach includes a new securitization standardized approach, or SEC-SA, to calculate risk weights for securitization exposures. We expect that SEC-SA would lead to generally higher risk weights for securitization exposures compared to the existing standardized approach, which utilizes the simplified supervisory formula approach, referred to as SSFA, and the gross-up approach to assigning risk weights for securitization exposures. The SEC-SA method is based on the SSFA with some important differences, and this slide highlights a few of these differences. Both SEC-SA and SSFA use various inputs or parameters to calculate the risk weight for securitization exposures, including, among others, the attachment and detachment points for the tranche of the securitization exposure, parameter W, which is the proportion of the underlying assets of the securitization that are defaulted or seriously delinquent, and KG, which is the weighted average capital requirement associated with the underlying exposures. and the supervisory calibration parameter, referred to as a P factor. The P factor is the rate at which risk weights decline as tranche seniority increases. For securitizations, Sec SA applies a p-value of 1, while SSFA applies a value of 0.5, which is important because it results in higher overall risk weights under the proposal as compared to the SSFA. The P factor is sometimes thought of as a capital surcharge for securitizations relative to the underlying assets. In other words, it's the percentage amount by which the bank's capital requirement would increase if the bank held every tranche of a securitization versus holding the underlying assets. The increase of P from 0.5 to 1 in the proposal increases this surcharge for securitizations from 50% to 100%. One potential positive change in the proposal is a decrease in the risk weight floor from 20% under the SSFA to 15% under Sec SA. For resecuritizations, the risk weight floor is 100% versus 20% under the current SSFA. Another potential positive change is a maximum capital requirement for certain senior securitization exposures, which can use the so-called look-through approach. This would allow capital to be capped at the greater of the weighted average risk weight of the underlying exposures and 15%. Lastly, I will highlight that the proposed expanded standardized approach adds 3 new operational requirements for synthetic securitizations. The most important of these would be a prohibition on originating banks from recognizing the risk mitigating effects of a synthetic securitization that includes synthetic excess spread, which also could be an important aspect of the rule for credit card banks. And with that, I will turn it over to Matt.
Great. Thank you, Julie. So Julie has covered, I think, the most interesting part for credit cards. But now I'm going to cover some in-between text that is changes in the rule, but that are not the most important. So historically, the largest banks in the U.S. were allowed to use internal models to calculate their capital. They didn't have to use the strict percentages that Julie just read. Instead, they could develop their own math models of the risk of an exposure. And this is still allowed in Europe and actually provides a considerable benefit in Europe and Canada for their banks. But in the US, it already was constrained because of aspects of the Dodd-Frank Act, and the proposal would do away with it entirely. And so for many of your banks, this is not an issue because you don't comply with it in the US. But for those who are part of foreign banks or who compete with foreign banks, this will be an issue that your home country or your home office may be dealing with a different approach to credit risk than you are using in the United States. Another change on the credit side of things is with respect to the leverage ratio, that the leverage ratio is a fallback, saying that let's ignore the risk basis. Let's look only at the balance sheet as a GAAP value and see capital versus the total balance sheet. And that's applied to the US again since the 80s. As part of the 2013 revisions, there was this idea of including some off-balance sheet exposures, mainly around derivatives, saying, well, even though they are off-balance sheet, and so they're not strictly within a leverage ratio, they do have a huge economic impact on most banking organizations, and so we should include those. And the model that most banks use to bring derivatives on balance sheet, it's called the current exposure method. It's about 25 years old. It's fairly simplistic. Some people say it overstates the derivatives obligations. Others say it understates it. The regulators kind of said, well, we don't care. We're going to find a more complex way to do this. And so going forward, all of the banks in the 100 billion plus bucket will have to use the standardized approach to counterparty credit risk. This is a math-intensive model that I think for some of the regional banks in the US or the banks who don't do a lot of trading, so some of the specialized credit card or payment banks or even some of the wealth management banks may find it a bit burdensome to have to implement the SACCR because it is math heavy. You do need specialists involved in it. And so even if it doesn't have a direct effect on the leverage ratio, it is a burden to implement. The other item here that I think may come closer to some of the wealth management or asset management banks in Delaware is for years we've witnessed the exit of banking organizations from the government securities market. And that's because it's a fairly low margin business. And any government securities that a bank holds on its balance sheet count towards the leverage ratio. And so why would a bank hold such a low yielding investment when it just isn't economical? And so people have talked about trying to change the leverage ratio to incentivize holdings of government securities and reinvigorate the primary dealer market. The proposal does not address that concern. And so we're continuing with the dysfunction in the treasury markets. The other, credit risk, which Julie and I have been talking about for the last few minutes, that's the risk of default, non-payment, person becoming delinquent, me not sending in my credit card bill. But that's not the only type of financial risk that a banking organization faces. That another type of risk is market risk. And market risk is the risk of changes in price. And the most obvious flavor or example is we look at the stock market every day and it goes up and down, up and down. And I watch my 401k and somehow even when it goes up, that doesn't go up. But banks have the same type of exposure to market risk for some of their assets. And so back in 1996, the regulators created market risk capital requirements, which are entirely separate from the credit risk that we've been talking about. And they said, look, most banks don't engage in trading. They're not prop trading shops. They're not a hedge fund. So we'll set some thresholds so that only banks with a significant amount of market risk need to calculate this, because the market risk calculations are absurdly complex. You need to know calculus to do them. It's many steps. And so back in 1996, the regulator said, we'll apply it to the banks with 10% or more of their assets in trading assets, or $1 billion or more in trading assets and liabilities. $1 billion is still a lot of money, but between economic growth and inflation, it's less than it was back in 96. And the proposal would raise the absolute threshold from $1 billion to $5 billion. And people may say, this is great. Oh, wow, that's wonderful. It actually only will exclude about 3 or 4 banks from the market risk capital requirements, that all of the 100 billion plus banks will still be picked up, even if they are smaller, if they have no market risk or very little market risk exposure. And so this is a concern of those banks who have little market risk, that they may now have to put in place the systems to calculate it, even though they have a small exposure. The other changes in the proposal, one we'll talk about more on the next slide, so I'll skip it here, but there was a concern from the regulators that banks were developing their own models to predict how much they had at risk in the market risk book, and that those models were too favorable to the banks. And so going forward, model use will be greatly restricted. And the regulators say that these risks are just too hard to model, and so that you need a regulator-imposed formula. It's really the regulators don't like bank-developed models, and so the regulators are more willing to, at least in this circumstance, trust their own model. The other change the proposal will make that's going to be quite burdensome, and I think it may affect some of the banks who are listening to this podcast, because it refers to trading desks. That for those who dealt with Volcker rule implementation about 10 years ago, there was the whole idea of, well, each trading desk has its own P&L, each trading desk needs its own compliance manual, each trading desk needs to assess its reasonably expected near-term demand, et cetera. The proposal would create a similar obligation for banks to map trading desks for market risk. And this is reflecting the view that, well, some banks might have been doing some netting that the regulators disagreed with, that if you had a long desk versus a short desk strategy, well, maybe you could find a way to net those out so that your market risk was lower. And so instead of allowing that organization level market risk, the proposal would make it trading desk. But the thing here to remember is that under the Volcker rule, there were some types of trading that was always allowed, regardless of whether it was measured at the market desk level. For example, government securities, that you didn't have to worry about doing a trading desk analysis under the Volcker rule for your government securities desk, or for some of your customer brokering desks was another example. Going forward, it will be all desks that have a market risk exposure. So all desks that trade assets or liabilities that are subject to these provisions, which again, we'll get to on the next slide. But this is going to be, we think, a pretty large operational requirement, particularly for organizations that have distributed trading desks across numerous offices or across different booking systems. Another issue that we're going to come back to a few times in the second half of this presentation is the fact that the capital rules, the proposal at least, is duplicative. And Jamie Dimon yesterday was railing on this. And so I feel now I can rail on it a bit more because he's more credible than I am. But so market risk is supposed to capture the tail risk of stock market valuation, but swings. So, what is the risk of 1,000-point decline on the Dow Jones? Again, it's more complex than that, but that's really what market risk is intended. And under the Federal Reserve's stress testing regime, and in particular the 2020 stress capital buffer requirement, that requires banks to hold a stress capital buffer against global market shocks. And what is a global market shock? It is an extreme variation in the price of assets. And so when you add market risk capital requirements to the stress capital buffer requirement, you are now counting that tail risk of a huge swing in the price of trading assets twice. And the proposal does nothing to address this. And so we expect this to be an issue, particularly for the banks that are more active in the trading sector, but it also will be an issue for the U.S. operations of foreign banks, because a lot of them have significant market risk exposures because they're big broker dealers inside an IHC. And then they also have a global market exposure through the Fed stress testing. Now, the part of this that lawyers are going to get involved in on market risk, at least I think we will, is on what is a market risk exposure. That right now it's primarily accounting driven, and it's a fairly subjective test that is not totally accounting driven. It's almost like the prop trading test under the Volcker rule, which Jamie Dimon likes to say, you need a psychologist, a mathematician, and a physicist at your trading desk to figure out what the intent of your trade is. And it's pretty similar to market risk. And the proposal says, well, we don't like this. We think some banks are playing fast and loose with when an exposure is subject to market risk versus credit risk. And we think this is a problem. And so we're going to require banks to document at the inception of an exposure whether it is a market risk or a credit risk. And we are going to expand the universe of exposures that must be held in the market risk book. This now will include nearly all public equity positions. So even if a bank has a de minimis investment for, say, a de minimis investment in the stock market or in an investment fund, which is more common for a bank, that will now be subject to the market risk rule. If a bank over hedges with a credit derivative or similar instrument, so say that you have one of these great capital relief trades that Julie is so good at structuring, and you sell out some of the underlying exposures, and so now you have an uncovered CRT position, that new short risk position, if it's more than 20 million, it will have to be put in the market risk book. Things related to CVA risk, which I am learning more and more about every day, because it turns out CVA risk is this expansive and duplicative concept that I did not know existed before the capital proposal came out. And then the big one here that I've been hiding the lead is that any trading asset or liability that is held for a regular dealing or market making business, if it's free of covenants on tradability. The proposal glosses over it like I did, but I think it's going to be a pretty big deal for banks because it expands the definition that there are plenty of dealing banks that may think of themselves as holding a long-term position as an investment and therefore arguably not subject to the market risk capital requirement. By doing this, the proposal will make all of those positions subject to the market risk capital requirements. And so it's going to be a big charge. And all of these changes in market risk will have a significant economic effect on banks in general. That one of the GSIBs, who will remain nameless in the US, said they expect this to increase their capital requirements for market risk upwards of 50%. And I think others are expected to see at least low double-digit increases. And in particular, the adjustment to the equity positions is part of a larger movement to really discourage bank involvement in equities that under the credit risk rules, we didn't cover them here because it's not as important to asset management where you're holding it for your clients. But the equity rules will be getting considerably stricter because there will no longer be a credit risk weighting of public equities, and there will no longer be a de minimis category of equities that can effectively be excluded from the capital requirements. But this is at the banking sector, and we are in Delaware talking about this. And so on a net financial impact for credit cards and asset management, it'll be modest, but there may be some exposures that are affected. Now, credit risk is risk of default. Market risk is risk of price change. Operational risk is something you probably haven't heard much about, that it's the risk of something bad happening, that teller pockets money from the cash drawer. That's an operational risk. Hacker hacks into the ATM network and shoots cash out of a little slot like in the movies. That's an operational risk. God forbid, bank catches fire. That's also an operational risk. The proposal would impose a capital charge to counteract the effect of these operational risk events. And it would replace the current approach, which only applies to the US GSIBs, with a standardized model that the regulators have set up. And this standardized model takes into account a portion of net interest income, a portion of the bank's historical losses from operational risk events. So these now have to be tracked in a fairly granular manner. And then a significant driver of the formula is a bank's fee and service revenue. And fee and service revenue sounds small, like the fees on my credit card, until you look at it in the aggregate. And so a bank would have to include all of its revenue for credit cards, things like interchange fees, annual fees, merchant processing fees, any data processing that you do. And for a credit card bank, this is a huge part of your overall revenue. And historically, it was not subject to a capital charge because it's a revenue item, not an asset item. For asset management, similarly, income from fiduciary and custody activities, which is enormous in Delaware, loan servicing, another enormous activity, investment management, all of the wealth and asset management activities in Delaware, insurance, sales, mutual fund servicing, all of these fees will now have a capital charge against them. And the regulator's theory is, well, if you are earning more fiduciary income, just for example, that if you're earning more income because you're providing discretionary asset management services, well, you're doing more of that discretionary asset management. And so there's a greater chance that you will mess it up in some way, that someone will fat finger a trade, or someone will make a conflicted recommendation. And so that's why we should tie operational risk to these revenue items. I am not convinced of it. I think Jamie Dimon is not convinced of it either. He said yesterday, are all revenues equally bad? What person in an ivory tower thinks that's a rational thing to do? And I agree with him that I think you can argue that things like credit card interchange fees, regardless of their scale, that scaling them up doesn't make them more risky. Whereas something like insurance sales, if you're in door-to-door insurance sales on a brokerage basis, yeah, maybe that does make it more risky. And in fact, we're treating all of these things the same under the proposal does seem a bit arbitrary. Now, CVA risk is the combination of credit and market risk, and it applies mainly to derivative transactions. And so we're not going to dwell on it, but I will say that this is another example of duplication, that arguably the CVA risk should be embedded in the credit risk that Julie was talking about. The regulators split it out here into a separate charge, and people have already been saying that it will result in holding duplicative capital. Now, for long-term debt, we are covering this today because it came out around the same time as the capital proposal, and it arguably has the same economic effect as the capital proposal. That right now only US GSIBs and IHCs that are controlled by foreign GSIBs are required to hold long-term debt, which is bail-in, or it's a subordinated type of debt that in an insolvency event could be converted to equity, and thereby allow the government to have a little more cushion before it has to bail out depositors. The idea was that the GSIBs are too big to fail, and so that you really need this bail-in debt because there's no other way to resolve them. The proposal says, yeah, that's true, but we want more optionality with 100 billion plus banking organizations. That we showed with Silicon Valley Bank that yes, we could resolve them, but we want more options. We want more of a cushion. We want more leeway. So we're going to impose these long-term debt requirements on all banking organizations in the 100 billion plus buffer. This will require regional banks to issue 70 billion in long-term debt to make that happen over the next 3 years. They also will need to restructure their holding companies if they are one of the handful that has active operations at their holding company. But I think the upshot here is that the asset management businesses will see a lot more bank debt entering the market. Now, there are a few other changes that the proposal makes, and one is to the way that the cross-border indicator is calculated. This affects the amount of cross-border derivatives dealing that a bank does, and it will affect 7 foreign banks and 2 US holding companies of a foreign bank. And it doesn't really change the capital consequences. It does change the liquidity reporting, that these banks go from monthly or quarterly reporting of liquidity to the regulators to daily reporting. And the form to do it on daily is a couple hundred pages, and most banks have a dedicated department for this. And so if you are one of those foreign banks who has a significant Delaware operation and you are moving up in categories, you have my sympathy that filling out the 2052A liquidity form on a daily basis is incredibly intense. And I think a lot of people struggle with that. Jeff and I have worked for years with people on getting the definitions right, because they really reflect trading businesses. They don't understand lending businesses in the way you would think they do. The proposal, interestingly, does not address cryptocurrency or climate-related financial risk. That even though this is supposed to be the end game, just like the Marvel movie that was supposed to wipe out everything, it is like a Marvel movie in that there will be another edition of it. And so while we don't know when or how, we can expect the US regulators to do something about cryptocurrency and climate-related financial risks, most likely in a capital setting, but probably closer to the second part of this decade. Now, when Jeff talked about the output floor at the beginning, this was something that for a while I was glossing over, because I kind of said, well, the output floor doesn't matter because the US set the output floor calculation in a way that it almost never will apply. That the output floor looks at the current approach to capital with the current risk weights, the fact there's no operational risk included, and it compares that to the enhanced version that we've been talking about. And it says that you can't go below 72% if you're using the older version. And it turns out that almost will never occur just the way the math works. And so I was like, well, the output floor doesn't really matter. But it does, because in Europe, they have an output floor. And the way it was constructed in Europe, it can be either. And so banks can structure themselves in Europe to be more capital efficient, and it will allow them to effectively take a 28% discount over what the lowest is the US bank could do. And so we're seeing this as a competitive issue that US banks will frequently be at a structural disadvantage, that no matter how they price an exposure, they always will have to hold more capital against it versus their European peers. There is a question in the preamble that I hope does not come to pass, but it says, should we require banking organizations to perform due diligence on their exposures to see whether the capital requirements are appropriate? And the idea here is that maybe the regulators messed up, maybe a bank has some kind of esoteric exposure, maybe a bank knows its own risk better than the regulators do. And so banks would have to perform due diligence to say, well, this loan to Julie should be this credit card is a 55% transactor risk weight, but we know that she lives in an area that's going to have a lot of job losses, and there's some other things. So we think the regulatory capital requirements are understating Julie's risk. And so we really should hold 63% versus 55%. And this would introduce a terrible burden on banks of having to always be second guessed on whether they had conducted appropriate due diligence. That basically, if a bank ever suffered a loss, the regulators would say, well, why didn't you identify that as a risky category and hold more capital against it? And unlike now, you can't say, well, I was following your rules. You'd have to say, okay, I'll do my due diligence better next time. And the proposal doesn't say this will come to pass, but I could easily see this being put into a final rule. There are some other changes that are less relevant around the countercyclical capital buffer, and that's an add-on that is supposed to take the punch away when the party's getting good. That the idea is if you raise capital requirements when the economy is doing great, you can blunt some of the effect of the following recession. The problem is no one in the US government wants to slow the economy down when it's doing great. In fact, we even see now with inflation how much fear there is about slowing the economy too much. And so in the US, we've never turned the countercyclical capital buffer on. So the fact that it'll apply to all of these 100 billion plus banking organizations is of relatively little importance. Now, this dual stack chart here, I floated around in the deck depending on who we're talking to, but it just shows going forward all of the different things that banks will have to calculate. That right now, banks calculate what's on the middle, the general credit risk and maybe the market risk. And if you're in the 100 billion plus club, there are some banks that have only the general credit risk because they're simple non-trading banks. Going forward, you will have to calculate everything. You'll have to calculate the general credit risk, the enhanced credit risk that Julie talked about, the CVA risk, operational risk, market risk, and then figure out which of the two is subject, is the greater, and then apply that to your regulatory capital. And this operational burden, not operational capital, but operational burden, is something that a lot of banks have raised concerns about. That if you are a regional bank based in, say, Alabama, or based in Tennessee, or based in Minnesota, if you are an asset management bank based, say, in Delaware or Ohio, you don't have the staff to calculate all these things. You don't have the systems. You don't have the data flowing through on a daily or quarterly basis to output all of these numbers the way the regulators want them to. So I know that Delaware just started their data analytics institute. I forget which Delaware school it's at, but those graduates will have really a full employment situation under this, that I see a lot of good jobs for those people going forward. Now, there is a transition period, and it is, the regulators say it's generous. It's 3 years. It's not really. You have to recognize 80% of the change in the first year. And also, as we all know, in our organizations, 3 years flies by. And so really this idea of a 3-year phase in for the capital and also for the long-term debt, we are going to be seeing tremendous amounts of either bank capital raising, or, and I know Julie is hoping for this, a lot of securitization to help banks move risk and move assets off their balance sheet so that they don't have to hold capital against it. And so we'll probably see a mix of those things. The economy will drive some of that, but if we get a huge rebound quickly, banks may be more willing to issue equity and debt. If things are slow going, Julie may be getting some more calls to do more securitization. I'm sure she won't be sad about that. Now, we have some concluding thoughts, and I'm going to open the floor to my colleagues also if they want to provide them. That we have tried to benchmark where we think it will affect Delaware banking institutions. And one here on credit cards I want to dwell upon because it is something that has a good argument to the regulators that, as Julie said, going forward, banks will have to hold capital against the undrawn portion of a credit card. And that was the whole $40,000 example on the earlier slide. Banks don't make money off of an undrawn portion of a credit card. It's not like they're charging interest on that undrawn portion. And so the fact they have to hold capital against it is a huge disincentive to allowing people to maintain generous credit limits. That I've maintained an enormous credit limit from my bank for many years, come close once on my honeymoon to the limit, but usually I'm a small fraction of it. But now going forward, my unused limit will be a drag on my bank. And so if the bank is being practical, it may say, well, let's reduce Matt's limit. If we look back historically, he's not going above this percentage. So we'll come down to maybe that percentage plus 20%, and he'll still never notice it. We'll hold less capital and he'll still get to use his credit card. And from the bank's perspective, that's a rational behavior. But what has the bank done? They have just made my card utilization go through the roof. And so now my credit score is going to be impacted because the next month it's going to show an 85% utilization on my credit score, and the reporting bureaus are going to freak out that now I'm using a huge portion of my lines. And this is going to happen across banks as they cut their limits to avoid the capital charge on the undrawn limits. And so the result of this will surprisingly be a decrease in consumer credit scores, which I don't think is what the regulators want. And that's just on the credit card piece of this. Some of the things on the commercial side, like Julie was saying with the cross default provisions, that could have huge ramifications for the real estate sector, for fund businesses that, again, use selective default as a business strategy. And so there are a lot of unintended consequences by the regulator's solution of, well, if every bank holds more capital, then we won't have another bank failure, which isn't true, but also this is the wrong hammer to be using for the nail. But Jeff and Julie, do you have thoughts that you'd like to add?
Just the one thing I would say, Matt, is I think when you look at what people are saying about the proposal, there's a lot of focus on increased capital requirements, the increased cost of capital. But there are a lot of operational and reporting things that are going to incur significant costs. And I think those costs are going to be particular for the kind of the tier 3 and tier 4 banks who historically haven't had to do some of these things, who don't have the systems in place to track things like market risk or to measure things like that. I think that's going to be significant. And I think that's an understated cost in the marketplace where people are focusing on the actual increase in capital. But there's going to be a huge cost for systems and being able to track, being able to just tie things together. Like go back to your credit card example, right? To just be able to tie customer behavior, customer performance with the exact, capital you're going to be holding against that account. So basically your capital requirements for a credit card are going to be basically determined by the cardholder, whether they're paying their balance or not, right? So those are things that you have that information, you report it to the credit bureau on a monthly basis, but you may not be tying it back to your capital. Same thing on the LTVs on some of the real estate loans. I just think measuring and calculating those things is going to be a significant cost. And I don't think there's really been an appreciation from the regulators. And I don't think there's really been enough said by the banks in the market as to some of these costs. And again, I think they're really going to be borne by the kind of the tier 3 and tier 4 banks who aren't currently doing a lot of this. So that's just one thing I want to leave with people to think about.
I will add one other thing, which in terms of the increased operational complexity for tracking this for credit cards, I think that there is some complexity with the types of different promotional programs that banks offer, in terms of, no interest for a certain period that, may require some additional discussion as to, what is and isn't a transactor card for cards with promotional terms. So I think that adds complexity as well that banks will need to consider in trying to determine which risk weight applies to different segments of their cards.
Thank you for those insights. And the other slide here is, this isn't necessarily the audience for it, but one thing that we've been hearing from other audiences is around the need to either exit businesses or engage in M&A. That smaller banks, the cat 3s and 4s that Jeff was talking about, may feel the need to bulk up because there is an economy of scale. That say a bank that's 130 billion may aspire to be a $270 billion bank because it lets it spread the cost of all those statistics PhDs over a larger pool of assets. The other thing is that banks may exit businesses, things like derivatives, loan servicing, credit card processing, that if the fees are higher and the complexity is higher, we may see banks exiting those businesses. And so I think that is a concern for them. And then the final point here is we were surprised when we started digging into the market risk rules, just how and when certain banks are triggering them. That there are some absolutely tiny banks, like in the $3 billion range, who trigger the market risk capital rules based on that 10% threshold, that they have more than 10% of their assets are linked to trading. And with the expansion of market risk assets, that with the inclusion of all public equities, banks aren't going to hit the 5 billion number. That's not the concern. The concern I have is that smaller banks in that sub-$100 billion bucket are going to hit the 10% threshold, and they're going to be subject to a lot of calculation, wild market swings. And so I think this appreciation by smaller banks, that if I'm doing any kind of securities activity, even if I think it is a customer facing or an accommodation facing, or even if it's in relation to, say, mutual fund management, that I really need to have a top-notch understanding of when it becomes market risk and if I could trip that 10% threshold. That we were just surprised to see some of the small banks that under the current more lax standards have tripped it. And so that knowing that going forward it will be stricter and more expansive, that's something that we're concerned with. We want to thank you for spending time with us this morning, or if you're listening to this on a recording at a later date. We are here as a resource for you, that we do these kind of things all day. We're about 1,900 lawyers across the country and around the world. And we really enjoy talking about these issues. And so if we could ever be a resource, even at a later date when you're listening to this and you can't put a question in the box, please feel free to reach out to any of us, that we're always happy to talk. I want to thank my co-panelists, Julie and Jeff. It was great for you guys to be on, and I think they appreciated your insights. And with that, I'll say that the final slide is Basel 12 is the CLE code. If you're waiting for CLE, that again is Basel 12. Thank you, and have a great morning.